The first 9 months of 2020 has been extremely eventful for global investors. My name is Abel, and as we move into the fourth quarter of this challenging year, we have two experts with us today, Mr. Heng Kun Hao and Mr. Tony Razak, to share with us some of the insights and their thoughts for the last quarter of this year. Let me start with Kun Hao. Kun Hao, what do you think of the global economy?
Thanks to the massive amount of monetary policy easing and stimulus by all the governments across the world, the global economy has recovered much faster than most of us have anticipated. In China, the consumption, activity, manufacturing numbers have all rebounded strongly back to pre-COVID levels. China's GDP should recover to trend growth of about 5% annualized by the fourth quarter of this year. And that will lift Asia exports back to about double-digit growth. In the US, after a very disastrous second quarter GDP contraction, the third quarter should also see a very smart rebound. Having said that, job markets everywhere are still very challenged. Certain industries and sectors are still in dire straits.
Does this mean that interest rates are likely to rise?
So the US Federal Reserve has committed to keep interest rates at zero for at least in the next 3 years. Now what this means is that in Singapore and the US, money market rates in the short term should be stuck at 0.25%, for the near horizon. The thing to take note is the longer term horizon, where longer term bond yields may be at risk of trending higher because many governments have issued a lot of stimulus and taken up a lot of debt. But overall, if it goes well, we should see a better 2021.
That's interesting. Now let me turn to Tony. What does this mean to global equities and the fixed income markets?
While the global economy has been hit hard in 2020, most investors are surprised to see that global equity and global fixed income markets have actually performed quite well. This divergence between the real economy and global markets has never been larger. Nevertheless, we continue to recommend to investors that we think it's okay and even appropriate to stay invested in these markets. We see three main reasons why we think the market outlook is fairly solid. Firstly, the global recovery is significantly ahead of expectations, with most economic data points surpassing the consensus of economists around the world. Secondly, the advancements in treatments, testing, and vaccines is progressing well and is significantly ahead of the schedule that most investors thought were possible initially. And thirdly, the global policy response around the world is stronger than anything we've seen before. Governments are providing fiscal policy to support the income of households around the world, and the central banks are keeping interest rates low and liquidity ample. Taken together, we think these three trends are going to be supportive of markets over the fourth quarter of 2020 and into 2021. For equities, we recommend investing to a neutral allocation, and for fixed income, we think that the ultra-low rate environment is going to provide stable returns on a risk-adjusted basis.
Thank you for your insights, gentlemen. It gives us a lot to think about. I think three key challenges really sticks up for us. Number one, we think valuations in US tech stocks is high and could lead to volatility. Number two, disappointments in the vaccine creation or development could put a stall on the current economic recovery. Last but not least, the US presidential election could create more tension in the US-Chinese front. For investors, we recommend the following actions. Number one, be risk aware. Invest according to your risk. Number two, invest in a diversified portfolio. That way you can mitigate some downside risk. Consider even adding short duration bonds. Number three, identify sectors or asset classes that are lower in valuations. Take for example, Asia ex-Japan and the healthcare sector. And last but not least, keep some spare cash. Identify market pullbacks and invest in those entry points. Speak to your UOB advisor today and understand how you can implement these steps in your portfolio.